Hey traders, this is Blake Morrow with Forex Analytics, and you're listening to the week ahead video for September 24th, 2023. I hope you guys and gals had a great week. It was such a busy week last week with not only the Fed, but 12 other central banks had met. A lot of volatility up the wazoo, and I know a lot of you are looking forward to kind of a slower week as we're only really waiting for PCE. Or are we? You know, this is going to be actually, I think, a pretty kind of stressful week because we're about a 1 week away from a U.S. government shutdown. So I would assume that negotiations, U.S. shutdowns is going to dominate the headlines this week. Of course, we got other things that are happening this week, and we're just trying to get to the jobs report at the end of, or at the beginning of next month, which is in 2 weeks away. So there's going to be a lot happening. So make sure you all stick around for not only my analysis on currencies. Obviously, I'm going to take a look at the indices, but there's a couple charts that I think are really important this week that we should all be focused on because they look vulnerable. I say vulnerable, I should say they look threatening. They look threatening to risk right now. And we're going to talk about those here in just a second. But like I said, we got so much to talk about. So let's just get to it. I want to take a step back really quick as I'm getting prepared to show you all the charts from this last week. But I want to talk about what really turned the market, in my view, based on the Fed meeting. If you look at the markets, and let's just go over to stocks really quick, and I just want to show you the chart from last week, which I believe, and correct me if I'm wrong, this was our thumbnail showing you that we are really close to a breakout. Well, obviously the breakdown happened after the Fed, and we continued lower throughout the course of the week, and to close the week at the end of the week at our lows. Now, I'm going to talk about this chart in greater detail a little bit later, but what really happened there? And, I've been speaking with, every week I speak with Jim Welsh from Macrotides, and he's like, man, the Fed's been very, clear in their messaging, but for a long time. But what's interesting is the market chooses to hear what it wants to hear. I think if you look back at the Fed interest rate decision this week, when the Fed chairman basically said, we are looking for a place to get to stay as far as rates go, that told me two things. A, we weren't done yet, at least unless data dramatically changes. He's not done raising rates. And then once he gets there, it's going to stay there. Rates, the terminal rate, wherever it ends up being, the Fed's going to keep rates there as long as they humanly can until it breaks something. And I think the market finally got that message this week, and that's why stocks really came off, in my view. Plus, there's obviously other things that are affecting the market, but that was the big catalyst in my view. Now, I did talk to Jim Welsh from Macrotides this week. I'm going to try to leave a card here so you can go back and watch that video that was filmed yesterday, actually. So it's always a good time meeting up with Jim on the Trader Summit. But anyway, I want to go ahead and talk about a few other things. Really, the government shutdown. How's that going to affect the currency markets? And I think that's going to be really important to discuss because I think one of the key charts, if you haven't seen it already, most of you will already know this, but the bond market has absolutely been breaking down. And, as the market breaks down, and I know a lot of people are thinking, wow, look at treasuries. U.S. treasuries are just selling off. Is this the market really suggesting that it's losing faith in the U.S. government because there's a government shutdown looming? You could say, yeah, possibly, but I would also argue the point that you're seeing yields rally really across the globe. It's not just a U.S. phenomenon. You're seeing boon sell-off, gilt sell-off. You're just seeing yields globally rallying, and even JGBs to a certain extent. So the reason why I say that is because if we have a government shutdown, and that's a week from now, and we should probably talk a little bit about what that actually means. But how's the FX market going to respond to that? And my simple answer is going to be they're going to look for something in a safe haven type of currency. And as unconventional as it sounds, because conventional wisdom would tell you, yeah, you don't want to own dollars. Dollars might be the place where the market goes. If everybody's selling treasuries, not only U.S. treasuries, but let's say, fixed income across, the globe, and they're looking to park their money in cash, notice that the dollar is right at major resistance here around the 106 level. Now, the reason why the 106 level is such a big deal, and we talk about this every week here, is there is a 38% retracement. It's this green line, and we're basically on it or slightly above it, you could argue. And, if we start breaking through 106, that's going to really catapult the move higher. Now, there's another conversation I had this last week, and I want to talk a little bit about this really quick before I really dive into all the charts and all the different currencies. I haven't even talked about what's happening next week as far as from the calendar point of view. I also had a conversation with Mark Chandler of Bannockburn, and I'm going to also put another link to his interview there. But something that we've been talking about for the last several weeks here on the week ahead video is how positioning in the euro dollar in the CFTC data still shows a very large position of euros being held on the long side by institutional players. Now, it's interesting because we've seen such a big move in the euro dollar lower over the course of the last several weeks. Is this a point where institutions are like, nah, the euro's definitely going back to 120. I don't believe it. The dollar is going to go down. What's going to convince them and what's going to get them out of these positions and get that positioning shifting the other direction? Maybe a flight to safety could be it over the next week as people get a little bit more nervous about a U.S. government shutdown. Now, I want to talk a little bit about a government shutdown and what it means, because I think a lot of people, look back at like 2018, was it 2018, 2019, in the Trump era, but they passed a lot of appropriation bills that allowed, most everything. Basically, the U.S. government was in a shutdown technically, but it was still, paying, its bills. But imagine if this time we go into a shutdown and that doesn't happen, there's going to be millions of Americans that will not be paid, will not receive paychecks, between military members, between government workers, and that alone could really affect GDP. I think I was reading a statistic where Goldman said for every week the government shutdown, it could affect GDP by 0.02% or something like that. It's some figure like that. The fact of the matter is, not only will GDP suffer, which is something that obviously the Fed's going to be watching. It can affect employment, sentiment, and then obviously sentiment towards global growth as a whole, not just U.S. growth, but global growth, as the U.S. economy is one of the bright spots in the global economy right now. That doesn't mean it's always going to be that way. It just happens to be right now. So therefore, this government shutdown and the headlines that you're going to hear and you're going to see this week could really threaten the volatility in this market. And that's what brings me to my next point that I want to talk to you guys and gals about. Take a look at volatility and take a look at copper. These are the two things that are really, and let me get to it real quick. Here's the VIX. We've talked about the VIX being at support, coming out of the wedge. Didn't really do much, but notice the first time we came out of the wedge rather, but notice how we're right at the 200-day moving average. Now, reason why this is important, because if volatility really starts to increase, VIX, the volatility on the S&P, if that starts to increase, that volatility is, based on where we're currently at, is not a good thing. It's going to be a bad thing. It's going to be threatening to break out to the upside. And if it does, and we start to get a sustained break of like, let's say 19 or 20, that's going to be, the market is basically a little bit more risk averse. Now, what else is cluing us in that the market might be a little bit risk averse at this point? Take a look at copper. Copper is threatening a major breakdown. On Thursday, we started to break lower, but on Friday we kind of recovered. But I would argue we're right at support. Now, one of the things that stands out to me in this chart, and I'm going to just show you really quick, is you'll notice that we had a false breakout right there. That was back in August. That false breakout, usually when you get a false breakout of a technical formation, there's a higher probability that we're going to get a breakdown. You know, if we get a false breakdown, then there's a higher probability of a breakout going the other direction. Doesn't mean it's guaranteed, but you know, the risks are obviously building. And so right now you start to look at volatility is breaking down. U.S. government shutdowns is becoming a higher probability. Copper looks weak. China can't, get their growth, that the second growth engine or the other growth engine of the global economy is really sputtering as well. Copper is a risk. And then you want to throw something else on top of it. Just throw in this rally that we're seeing in crude oil. The crude has been very bullish. It's holding its breakout points. You can see it's at this $88 level. It's not backing down. That means it's consolidating gains. Its bull flag still targets 96. So when you see crude rallying, energy costs and commodity costs are going to be high. Then you got growth slowing. Then you have a potential U.S. government shutdown. Then on top of that, you have higher volatility. This is all a recipe for downside in equities. And so that's why the risk is real. And this week, I know everybody's going to be looking at the data, and we'll talk about it here in just a second, looking at the data and thinking, well, there's, it's all secondary data. Not, there's nothing really too terribly important. You're right to an extent, but we still have a central bank that's meeting. We have PCE, which is the most important data that the Fed looks at from an inflation standpoint. And we're going to start to take a look at a lot of final GDP numbers, across the globe. So buckle up, folks. We got a lot to talk about. And as we do that, just make sure you guys check out Forex Analytics when you get a chance. You want to join one of the most active trading communities out there in the markets. You could do it through with us at Forex Analytics. So check it out. It's $1 for 10 days just to try it out. Make sure you download the mobile app. Make sure you jump in the chat rooms. The chat rooms look just like this, so you can kind of see what we talk about. And we have our news chat room, general chat rooms, S&P room, our trades room. We post where we're buying and selling, and I think you can see some of my positions. My last positions of the week, somewhere where I posted them, where I was kind of scalping in and out of things. Anyway, it's not just me, but it's everybody else too. You can see. I'll just tell you one of my positions that I just got out of. Right here. Let me get over to it, wherever it's at. I thought I just saw myself. Anyway, you get the picture here. My average short in the Aussie dollar is at 64. There you go. You kind of know where I'm positioned, right? Okay. Well, with that being said, let's go ahead and get into the markets, and let's get into what we got going on this week, which is a lot. Like I said, I'm going to go ahead and get me out of the picture, and let's get over to some live charts, and let's cover go back from the week ahead video of last week and kind of see where we're at. All right. So Monday morning, we have the German IFO. I mean, you want to see how the German business sentiment is right now. Why? Well, that's because if you look at the PMIs out of Germany, Germany is, I'll use the way I've heard it described recently. It's a basket case, right? Germany is a bit of a risk, as this is the Eurozone's, main manufacturing hub. And so the German IFO numbers first thing Monday morning are going to be watched really carefully. Now, if you are looking at the euro and you're looking at the support that we're at, we talked about this last week. We are at the 38% retracement, which basically comes in at 106. It depends on what feed you're using, but basically 106.10, or you can just call it 106. If we start breaking through 106, not only are we breaking through the 38% retracement, but you're also breaking through horizontal support that you can see right here. And once you start breaking that horizontal support, does it start to worry the longer term euro bulls that we were just discussing? I think it does. And that's why, you look at the daily charts and you go, okay, we're at pretty critical support here, but relative strength isn't even oversold yet. So if you start seeing the RSI break through, there's a good chance we could be trading below 105 in the week or weeks ahead, especially if we get a government shutdown, a U.S. government shutdown, and investors start looking to buy dollars as yields are rising and they're selling U.S. government debt. All right, so that's something that we need to be paying attention to. Also on Monday, you have Christine Lagarde and Schnabel speak as well. So a couple of ECB members are going to be speaking on Monday. Now on Tuesday, one of the things that I wanted to talk about is that we have U.S. consumer confidence. Now, the U.S. consumer has been surprisingly strong. I think that's the one thing that we all, as Americans, you look around, you're like, man, you're not really going to change their minds in buying the new Apple iPhone, right? But the fact of the matter is, with energy costs, inflation, data as strong as it is, and savings dwindling, and student repayment loans are starting again, and on top of that, inflation is extremely sticky. At what point does the consumer buckle? And I think everybody's going to be watching consumer confidence. We also have new home sales that are happening that day. And why is the new home sales data important? And I think house price index is also coming out that day, if I'm not mistaken. It's because everybody's worried about the U.S. housing market, because that's the one thing that hasn't collapsed. But I'm going to tell you guys, I think the process here is going to be threefold before you start to see the U.S. Housing market really come under pressure. And everybody knows this. I explained this last week, but I'll just, in a nutshell, so many homeowners are locked in at 30-year home loans or 15-year home loans at like literally, 30-year home loans would be sub like 3%, even, some of us are like in the twos. But then you have a lot of people that are below, 3-4%. And when home rates or home loans right now for new home loaners around 6.5 to 7 to 7.5, depending on your credit scores or whatnot, people don't want to move. And so you got this, the stagnating real estate market. Yet no one wants to sell because you take somebody's mortgage that is a certain rate. People are paying more for apartment rentals for a quarter of the size based on what somebody might be paying in their mortgage, which is a true statement. So when you think about that, people just don't, we're kind of stagnating, but wealth is still holding on, if you will, because your home prices aren't really going down. So how does the housing market shift? Well, the housing market shifts by, as people are forced to sell. What would force somebody to sell? If they lost their job. Now, that wouldn't be the first thing to go, because the first thing to go would be your credit cards. You would say, okay, well, I lost my job, so I'm not going to pay my credit cards. What are they going to do? Tear up my credit card? Who cares? It's going to hurt my credit, but they ain't going to hurt me. Next thing to go after that, your auto loan. That there are so many new cars, because a lot of people say that the auto industry and auto loans will be the next subprime big defaults here in the U.S. That is a risk, but it'll be credit cards first, then come take my car, come tow it away if you really want it. And then after that, it's homes. So there's a process. So we'll be watching the housing data here in the U.S. And I think that everybody's watching it, but I think they're watching it prematurely, if that makes any sense to you. So, all right, continuing on. That was the housing market. Now that night, or it would be Tuesday night, Wednesday morning, we have the BOJ meeting minutes. Now I'm going to talk a little bit about the yen really quick because first of all, do I think the meeting minutes are going to matter? Answer to that question is no, I don't. The BOJ, because I think the meeting minutes were from a couple months ago. I think back in July, if I'm not mistaken. Anyway, they're old, but it's also going to talk a little bit about some of the YCC changes. But if you go back to the BOJ this last week, basically Ueda seems very not willing to mess with rates or yield curve control, and where that band is right now. He's not willing to mess with it at this point. Now, the reason why the dollar yen hasn't broken higher is because we are in levels that the market is rightfully, worried about intervention. And you can see the upside to this channel comes in around 150. And you can see back over here in October of last year, this is where, intervention started to take place, verbal and actual intervention. So, the bull flag pattern still points to, 150. The channel resistance comes in at 150. The 161% extension of this entire move lower comes in at 150. That seems like a pretty logical target, but you also have to think that, buyers at this point are getting a little nervous, being on the long side of dollar yen. But as yields continue to go higher, the path of least resistance continues to be higher as well. So I wouldn't worry about the dollar yen as far as a reversal, unless you start to see us break into making lower lows and lower lows and lower highs. But also understand that if you are on the long side of the US dollar, Japanese yen, you could literally close your eyes for a bed, get up, and the market can be below your stopped you out well below the market because there was intervention, and that can happen. So, if you're on the long side, you have to trade in such small quantities to compensate for the risk of your stop being taken and you being taken out of your trade 100, maybe even more pips below the market. That is a reality, and that's why traders that are looking for that are long, have to be a little bit careful, even if you're trying to capture the carry interest of selling yen and buying other currencies, dollar yen or anything else of that nature. Okay, continuing on. Wednesday morning, which would be Tuesday night, but Wednesday morning in Australia, we have the Australian CPI. Now, looking at the Aussie dollar, I've kind of shifted the way I'm looking at it over the course of the last couple of days. I'm kind of viewing it more as like a flat type of consolidation. It looks like this. Now, also realize we are in very, very big weekly support. What chart does that look like? Well, looks just like copper, doesn't it? That we were discussing earlier. Let me get rid of that I drew out earlier. Looks just like copper, doesn't it? Yeah, it does. So if you're looking at the Aussie dollar and you're looking at it at support, watch copper, because if copper starts to break down, the Aussie might as well. I have said throughout the course of the week, the Aussie is still very sticky around the 64-cent level. But if copper starts to break down, my assumption would be the Aussie starts to break down with it. Now, do keep in mind that we have Aussie CPI. Now, I don't think inflation is the most important data for the markets at this point globally. I think everybody's come to the conclusion that some of the deflationary pressures globally have pretty much subsided almost, and we're seeing inflation become more sticky. But I think everybody is aware of that. So what everybody's going to be looking at right now moving forward, as some of my colleagues like Ryan Littlestone or K-Man have been mentioning this week, people are going to be starting to look at growth. And that's why some of the GDP data throughout the course of the week is going to be very important. All right, on Wednesday, we have, speaking of growth data, on Wednesday, and this is probably a good time to just take a look at the dollar index again, even though I've mentioned it before, but I need to reiterate here. Let me find the dollar index. Is going to be durable goods orders. Now, the dollar index, once again, We are up against really key resistance, the 38% retracement. You got that high that's over here of March of this year. But notice, and this is something about the price action in the dollar. The dollar is not backing away. It's consolidating gains. So when an asset class moves higher and then stops and then just consolidates, the higher risk is a continuation, because it's not getting anybody who's shorting the dollar is not having an opportunity to get out. And people that want to be long the dollar, that are like, oh, I think the dollar is going to 110, they're not getting an opportunity to buy on a pullback. So, the longer we sit up at these levels, the more the risk is on a breakout. Now, I always say this, and you guys have heard me say this for years and years and years. Assets always look most bullish at resistance and the most bearish at support. Okay, you've heard me say that. We are at resistance in the dollar. It does look bullish. Does it mean it's going to break out? No. But if we get that government shutdown that we were discussing, is that maybe the catalyst that drives the dollar higher? I would think that there's a good shot. There's a good shot at that. All right, continuing on. So that was Wednesday, U.S. durable goods orders. Thursday, we have Spanish and German CPI. Again, Euro is going to be in the spotlight there. Remember, we are at really critical support. There's a town hall meeting with Fed Chairman Powell on Thursday. Now, do keep in mind that it is the Fed chairman, but it's also at an education town hall, I believe, if my memory serves me correctly based on what I read. But that doesn't mean that he won't talk about monetary policy, because he probably will be asked some questions in this town hall meeting about monetary policy. So just keep that in mind. That is on Thursday. We have then Banxico, that they have their rate decision. They are expected to keep rates unchanged. However, their mantra of higher for longer is also expected. But remember, there's a lot of LATAM central banks that are now starting to cut rates. So if you look at the dollar MEX, it does look like it's basing, and we're making higher highs and higher lows. If you haven't seen it, that is the 50 DMA. You can see that's the 50 DMA. That's that orangish, squiggly line there. That's the 50-day moving average. We're also held the 618 retracement that you can see here. We noted that on the dollar Mexican peso last week. So we held the 618, and we're starting to base. And so any type of dovish commentary dovish commentary from Banxico, that could put the dollar MEX back up towards the 1750s, and then keep in mind the 200 DMA is not too far away either. Now on Friday morning in Asia, but it'll be Thursday night here if you live in the United States or in North or South America or the Americas. We do have Tokyo CPI. I don't expect it to be a big mover, but again, if inflation continues to outpace forecasts, that could affect how people view the BOJ in the months ahead. On Friday, we have the UK final GDP. Now, look at this sterling. This is our chart from last week. You can obviously see we're making our way lower. We're coming towards that head and shoulder target that we talked about last week, which I drew out for you right here. As I mentioned to you last week, if we get close to 121, you probably want to start covering your shorts as you get down there, because what happens is you get a lot of orders that are going to be, layered down here as we start to reach towards the 120 level, because 120 is obviously the big figure, but everybody's looking at the same technical formation. So you're going to get people trying to outdo each other as far as trying to buy it back. So you're going to start to see buyers down here. I would suspect that once you start getting into the low 120s, well, we're in the low 120s, but let's just say like 121, maybe close to 120. Big head and shoulder pattern still in play, but we also have, like I said, UK final GDP. We also have the Eurozone flash estimates that day. Now, we also have, for GDP, we have Canadian GDP on Friday. Now, the dollar CAD, you can see in my drawings from, was it last week? I thought we would stop here. We went a little further. We went to the 50 percent retracement. Now, that's good to know because it's previous support, or excuse me, previous resistance. It acted as current support. Now, what I'd be looking at where we're currently at is previous support is resistance, even though we've had overshoots. But that's the loonie. The loonie will overshoot by 30 or 40 pips and not even think twice about it and still is respecting the same level. So, you have to keep in mind that is the loonie, but we are above the 200-day moving average. If Canadian GDP, even though it's backward looking, if it comes in worse than expected, maybe the 50, the 200 DMA, you can see right here, is all very important as support for the dollar CAD. So if we're staying above 134, maybe the risk is that we are heading back towards the 136, 137 level. So keep that in mind with the dollar CAD. Like I said, it went further than I thought it was going to go this last week. Therefore, I actually didn't play it that well. I think my average buy ended up being like at 134.50 or something. So I didn't play it as well as some of my other colleagues. Like I think Ryan Littlestone, he had a bid in at like 133.90, and he pretty much cherry picked that thing from the bottom. I mean, that's some good trading right there. But you can see very, very key levels, and it looks fairly respectful of these key levels right now. On Friday, we do have the US PCE. We have Chicago PMI data. We have all the University of Michigan consumer sentiment data. And I think what's going to be watched mostly when you're talking about all this US data is going back to the conversation that we've been having for the last several months, really, is US data continuing to be really strong. So PCE is going to be the data that the Fed is watching. That's their more of their inflation gauge that they're going to watch. You have the Purchasing Managers Index in Chicago that's going to be released. Then you're going to have University of Michigan. Even though it's a 5,000 person survey, it's still talking to a lot of Americans about how they feel about inflation and sentiment. So 5,000 people you might think is not a lot, but it's a pretty decent sample size if you think about like just who could be who those 5,000 people could be that is being surveyed. There is a risk that if the data continues to be stronger than expectations, look at the bond market and watch U.S. 10-year yields that you see here. We're continuing higher, and yields they will continue to move up, especially if people are continuing to be concerned about the U.S. What's the I just had a brain fart there for a second. U.S. government shutdown. That's going to be the other thing that the market's looking at. All right. Sorry, I didn't mean to have the brain fart live with you guys, but it happens. All right. Also, on Friday, last thing I'll speak about is FOMC Williams. He's going to be speaking on monetary policy as well. All right, let's take a look at some of the big indices. Like I said, I want to take a look at the S&P here because I believe that the S&P is at such key support. Now, we identified the breakdown of the triangle this last week, but most people right now, are looking at it as, yes, it's a head and shoulder pattern. Yes, it might be a more complex head and shoulder pattern. Yes, that's the 200-day moving average, and that's channel support. I think 4,200 is going to be really critical support, as this was the breakout point, right? That's where things took off. So if we get to 4,200, it is also the 200 DMA, right? So we got that head and shoulder pattern. We're at pretty critical support and closed at the weekly lows. Take a look at this weekly candle. That's not a pretty candle. It's a Morrow candle, which is probably one of the higher conviction, if not the highest conviction, bearish candles you could actually have on a chart. That doesn't mean that Japanese candlestick is everything and the bee's knees, but it is a pretty bearish candle, which you should respect it, especially being on a weekly chart. Looks like, you guys hear me say this, for those of you that listen to my analysis or my analysis live throughout the course of the week. And if you don't know how to get there, you can always go right here to where we have our shows, and we have the European show, and we also have the daily face show right here. But we talk about, a black candle, or in this case, a red candle, because we use the terminology black and white because that's old school before we actually had colors on charts. But a red candle like this is usually followed by another red candle. Big red candles are usually followed by other big red candles. Big green or white candles are usually followed by other big green candles or white candles. That means bullish, right? So you have to be really respectful of the fact that we're seeing this on a weekly chart, and it is one of the most bearish Japanese candlesticks, called a Morrow candle, that you can possibly find. All right, now if you want to learn how to take advantage of all of these things that we're talking about, hey, why don't you take a look at the Trader Funding Program? Check it out. Check out let me go over there really quick. You can find it on our website, the Trader Funding Program, or just go to traderfundingprogram.com. And if you want to learn how to, trade larger amounts of capital, let's say you don't have $25,000 to trade. Let's say you don't have $500,000 to trade. Maybe you don't have $1 million trading account, but you want to learn how to access that type of capital. Well, you just have to take an assessment. And so if you take an assessment and you pass the assessment, you'll be able to trade that amount of capital. So take a look at the Trader Funding Program if you haven't done so already. But that's one of the best and easiest ways to be in the Forex analytics community, because if you take advantage of the Trader Funding Program, you will be in the Forex analytics community for a certain period of time based on the assessment that you took. So check it out. All right. Now, I talked about the S&P. Let's also talk about the Nasdaq, because the Nasdaq, as you can see, we're at head and shoulder pattern neckline, but also channel support. You guys see how important that is? Let me go over to the daily chart. Then also look at the Russell 2000. The head and shoulder pattern that we've been discussing is breaking down. We're below the 618. So we are coming into levels that it's not uncommon territory for us to make it back down to levels that we haven't seen since October of 2022 is not a huge stretch for the market. Like I said, it's not levels we haven't seen. Now also take a look at the Dow. The Dow also is breaking down. We're nearing the 200-day moving average. We're breaking out of an ascending wedge. I'm showing you breakdowns in the S&P, the Nasdaq, we've been discussing this every week. Nasdaq, Dow, Russell 2000. If you're seeing the four major indices in the US markets going down and breaking down through major technical levels, that should be one big clue on how you should be positioned if you're trading currencies, you're trading commodities, you're trading individual stocks. Right? Right. Okay. One other index I wanted to go over. Well, actually a couple. You see the German DAX. We are at the 200-day moving average, major support. One of the things when you hit a brand new all-time high, like you did in the German DAX just in July, and then you get a reversal, that's not a good thing, because that means it got a lot of people long the German DAX. And why that happened as German PMIs slipped below contraction, I don't understand how the market interpreted that, other than maybe they thought that the ECB was going to be super dovish or something, or somehow start cutting rates sooner rather than later. I don't know. But anyway, the German DAX does look vulnerable since it made a new all-time high and then a false breakout. So what do I say here? False breakouts usually lead to breakdowns, right? So watch the German DAX. It's very, very vulnerable. And if you look at the Nikkei, probably one of the better places to be in the market, the Nikkei could very easily come back down to support, but 31,000 would be the key support that we'd be looking at if we drop all the way back down there. Now I'm going to, look at the Nikkei and probably say, okay, well, we can probably redraw that consolidation. It probably looks something like that, but it's not bearish. But if the global equity markets pull back, could you see the Nikkei pulling back to a breakout point? I could. All right. Last but not least, guys, and this is a big one. Let's talk a little bit about precious metals, but let's talk about gold really quick because, you know, although not a gold bear per se, the technical false breakout of this last week, right? You can see it of this wedge that we've been discussing, the false breakout and the rejection up here. And by the way, that was a pretty key rejection spot. If you look closer up, let me just take you in closer really quick. That was actually a 618 retracement rejection again. See it? 618 rejection again. That's twice. So we got this failure, and gold is, you know, now back under pressure. The risk with gold is that we might come down back into this wedge. But if we do have, like, let's say we get into the end of next week and we are, you know, a couple steps away from a U.S. government shutdown, one of the beneficiaries could be gold. Gold and the dollar tend to have an inverse relationship more times than not. Matter of fact, if I had to throw a number on it, I would say probably 80 to 85% of the time. If gold's going up, dollar's going down. Dollar's going down, gold's going up. But in a time that you see stress in the markets, you know, and people are looking for safe haven places to be, to park your money, gold and the dollar could be rising at the same time. So watch gold this week, because if gold does pull back a little bit and it looks like there's going to be a government shutdown, U.S. government shutdown, we could very easily see us come out of this wedge. I will say this: if we break through 1950, which is basically those resistance levels that you see there, we break through 1950, I sure as hell wouldn't want to be short gold. And that's pretty plain and simple. All right, guys and gals, you know, I hope that you've gotten a lot out of this video. And if you have, and you think that these videos are very beneficial to you, please give me a thumbs up. Please give our team a thumbs up for doing these videos for you each and every week, and jump in the comments below. If I missed something or you don't agree with my analysis, fine. That's what makes a market. Get down in the comments down below and tell me what you're looking at and what you're seeing, and we'll talk about it. And we'll have a nice discussion. All right, guys and gals, my name is Blake Morrow. Thank you so much for joining me today. I know, and spending your time with me. I know that your time is very valuable. It's your weekend. Go off and enjoy the remainder of it. I'll see you on Monday morning on the Face Show. Bye-bye. Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.